There are both good and bad debts in the world of finance. Bad debt is when you owe money on items that have fixed payments but depreciate. Owning an asset with debt that increases in value or generates positive cash flow over and above the debt payment and costs is referred to as having good debt. All debt carries risk, yet some debts are paid for while others are purchased outright. The United States has accepted debt despite all of this. With about $15 trillion in total consumer debt in the U.S., the average household now owes more than $5,300. The U.S. economy, as a whole, is made up of its gross domestic product, which is just over $21 trillion. The good news is that debt isn't always a negative thing. Given that the majority of our debt is bad debt, that opinion is not widely held. You most likely have credit card debt, a car loan, and possibly student loans, and you probably think it will take decades to pay off all of your debts. How in the world is it a good thing? Let's look at how wealthy people still use debt to earn even more money to better grasp how debt may be a good thing. It could sound a little perplexing since, in the first place, why would someone with a lot of money use debts? That means to be used by those without money, but capitalism doesn't operate that way. When used properly, that is a strong tool. Here, we examine the actions you can take to ensure that your debt benefits you rather than jeopardizing your future financial stability. Be sure to stay till the end to find out the number one tactic on how the wealthy make money with debt. 1. Debt-based trading. It may sound contentious because borrowing money to start a business is a terrible idea that I would never undertake. However, there are some industries, particularly traditional industries, where borrowing money is your best option. Let's take the example of selling pens. Pens are a highly common product, and there is almost always a market for them. Ideally, you would fly to China and locate a factory that manufactures that type of pen at a reasonable price. You would buy a box of pens, send them to US, and then give them to your customers. However, these days, most of that is done online through platforms like Alibaba. Unless the thing is more difficult and you need to travel by air to the plant. But here's the catch: you don't have to pay for the products in order to have them first. I'll tell you how. In the last 50 years, China has become the world's factory, manufacturing literally everything. Thousands of factories labor non-stop to produce everything that the world needs, and to make it easier to sell, most of these firms would gladly loan you their products in exchange for a future payment. Naturally, you will need to establish some sort of confidence with them first, as they won't lend to strangers. But that's how business has been conducted for the previous 50 years. Once the product was sold to the US or another country in the world, the client would pay the factory and borrow additional goods. In essence, you're telling the factory that you know how to make it, so let me help you market it. My profit will be whatever price I can get it for when I sell it. The benefit of this tactic is that you're not investing any of your own money in it. Selling is one of the most important skills you can learn because of this. 2. Leverage in real estate. With 5% down payments or monthly payments, purchasing real estate enables you to leverage your capital by multiples of 20. A real estate investor can purchase a $200,000 home with a $10,000 down payment and $2,000 monthly payments. Investors in real estate receive returns on the entire loan amount, not just the amount initially invested. The $10,000 down payment generates a 300% return with a $40,000 investment return if the real estate increases in value from $200,000 to $240,000. In order to produce cash-flowing assets for monthly revenue through leverage, debt can also be used to establish monthly rental properties or homes that can use as Airbnbs. The cash flow returns are based not on the capital invested in the property but rather on the total amount of debt. For example, if you manage to save $200,000, that is a significant sum of money. But if we're being honest, that's chump change for some. Not even a home can be purchased. Naturally, since a 20% down payment is required, you cannot obtain a mortgage for more than $800,000, but here is the trick. Consider the case when you discover a $500,000 piece of real estate that requires some, possibly a lot, of renovation. You go to a bank and pay a 20% down payment to obtain a mortgage. Let's assume that your renovation budget will be roughly $50,000, or about 10% of the house's overall cost. You visit your bank once more, only this time you want to refinance your mortgage. Because it was in such horrible shape and nobody wanted to live there when you received your first mortgage, the worth of the property was only $500,000. However, after you renovated it, tenants are now interested in renting it out. As a result, let's imagine that the property's market worth increases to $700,000. Let's imagine, as with the first instance, that you will receive an 80% mortgage, but 80% of $70,000 equals $560,000. The initial bank that provided you with the first mortgage will receive $400,000 of those sums. After subtracting another $50,000 from refurbishment costs, you will have an additional profit of $100,000. You gained $100,000 doing that, and you now own a home that you can rent to increase your equity and produce passive income. So, don't forget to like and subscribe to the channel. 3. Hedge funds. Hedge funds are created by the wealthy for the wealthy to make the wealthy even more rich, and they typically employ unpopular tactics. Mortals like you and I do our best to anticipate which firms will develop and increase in value, and we spend the money we have worked so hard to earn in the hopes that these companies will grow. But hedge funds frequently employ an entirely different approach. When businesses fail or go bankrupt, as it did in the instance of GameStop, they attempt to profit. However, in that instance, the internet confounded hedge funds and caused them to suffer a loss of almost $13 billion. However, how do hedge funds generate income from debt? Let's imagine you predict a certain stock will fall, like Facebook, because you know the company that makes the most popular smartphone, Apple, will declare next week that it will no longer allow apps to follow you, like Facebook or Instagram, to track your online behavior and will put privacy first, which will seriously harm Facebook's business model. So, you pick up the phone and contact your broker, asking him to lend you a single Facebook stock worth $100, which you immediately sell on the open market for $100. Now that you have $100 in your wallet, you still owe your broker for one Facebook stock. Let's imagine you are right and the price of Facebook stock decreases to $70 the next week. You use that $100 to purchase one share of Facebook for $70 due to a price reduction, sell it back to your broker, and keep the difference. Congratulations! You made 30 from a full stock. Though it appears straightforward in theory, doing it well is quite hazardous and complicated. What occurs if you are mistaken? What happens if the price doubles overnight? Do you still have to pay interest for borrowing that one Facebook share and return it to your broker? To return that stock to your broker, you must purchase it for $200. When you purchase a stock and attempt to sell it at a profit, the most you can lose is the amount you paid. But, when you short security, your losses increase as the price rises. Since the stock price might increase eternally, you could theoretically sustain a limitless number of losses. Nevertheless, if you have 100 analysts working with you, with this tactic, you can become very wealthy. Be sure to stay till the end to find out the number one tactic on how the wealthy make money with debt. 4. Forex Trading. With only a modest amount of capital, investors can control big blocks of other currencies through Forex trading. Currency traders can increase their accounts leverage by 100 to 1. One benefit of currency trading is that you may quickly turn a small quantity of money into a large one. George Soros earned $1 billion by betting against the pound and is credited as the guy who shattered the Bank of England. On the other hand, currency trading can quickly empty a trader's account. 5. Credit score. As you can see, debt is a powerful instrument that every successful firm or entrepreneur employs in a variety of ways, particularly if you have an established business strategy. Practically every business uses borrowing to finance purchase orders. Therefore, stop focusing on the negative. High-interest debts like credit card debts are terrible. However, reducing the risks associated with lending your money must be done to obtain a lower interest rate. How do you go about that? You establish a reputation for being a trustworthy borrower. Banks have billions, if not trillions, of dollars waiting to be borrowed, and even if there isn't any money, banks can manufacture money out of thin air.